Hello, and welcome to the video Accrual Accounting. I want to talk about the importance of having your financials set up in accrual format, and not just for going to market, but it should be part of your standard business operations going forward. Simply put, without accurate accrual accounting, your business will not sell. This video will walk you through the key aspects you need to know to have accurate financials. Topics I want to cover will be: what is accrual accounting, how do you implement it successfully, and the 3 financial statements to view your business. So what is accrual accounting? Typically, we see bookkeepers or accountants either using the cash methodology for accounting or the accrual-based methodology. And in a minute, you'll see that accrual-based methodology is the way to go, but let's just discuss the differences between the two. So cash-based methodology is all around when transactions are booked when money exchanges hands. So it's going to be cash in and outflows of the company. That's when you'll start recording the transactions. For example, you're going to record your income. Let's just say from Amazon, you get paid every 2 weeks. So every 2 weeks when you receive that income, it'll get booked as such. Also, when you record your product cost, let's say, you're ramping up for the holiday season and you want to stock up just so you'll maintain inventory levels throughout the holiday, you're going to see an uptick in product costs in August and October. At that point, as you're purchasing those products, those raw materials, what have you, it's going to be reflected in your accounting system on those dates. So you're going to see a peak through those months because you've purchased larger orders. And also, you're going to record your other expenses when your bills are paid as well. Typically, this is what we see smaller businesses. It's much simpler for you and your accountant to book and understand. But at the end of the day, it's not the best way to run the business. And more importantly, it's not going to be the best way to sell your business. People who come to us with cash-based accounting will eventually have to slip over to the accrual-based accounting. So accrual-based accounting is much different. It's not really based on when money changes hands. Transactions will be booked when revenue is recognized or when costs are incurred. So for example, revenue recognition, you're going to record your income when it's achieved. So when it's sold and shipped your products, that's when you'll record transactions for your revenue. Same thing with your COGS recognition. So you're going to record your product cost based on when your units are shipped and sold to customers. And you're also going to record other expenses when they're incurred, regardless of when they're paid, like in the cash methodology. So the required accounting methodology to get an accurate valuation and profit and to get a deal done is going to be the accrual-based methodology, because this is how buyers want to see your books at the end of the day. So it is probably ideal that if your books are not in accrual format, that you get them done as soon as possible to match this methodology. Let's talk about how accrual accounting sets the basis for valuation, because realistically, you won't achieve that premium valuation unless your books are in the proper accrual format. And this is how buyers will typically prefer to see your books, and that's what they're going to make an offer on your company off of. So in front of me, I have a profit and loss statement. It's a quick income statement just to illustrate how your P&L and it being in accrual formatting is tied to your valuation. So for example, revenue, as we discussed earlier, the full revenue for the month should be based on when units are shipped from Amazon versus that deposit method where you just record the cash coming in from Amazon every 2 weeks. Now, this is proper industry standard, and this is how buyers will want to see your books. Also, to arrive at an accurate gross profit, you also have to make sure your product costs are also booked when these items are shipped from Amazon. The contribution margin is going to be a key measure of your profitability, when considering both your product cost and your paid media or marketing spend. And we often see earnouts based on contribution margin. So it's a metric that should be properly monitored. Now, your SDE, your EBITDA, that's just earnings. Some buyers use EBITDA, some arrive at an SDE. But the point here is that, your accrual net profit will be increased with the addition of some add backs. And add backs are those excluded costs, which will help increase your valuation. And then to arrive at the actual valuation, buyers will place a multiple, and it's going to be a negotiated multiple on that business. So for example, in our profit and loss statement, we're just using a multiple of 3. So their SDE, their earnings, it was $200,000 over the trailing 12 months, and a buyer will come in and put that multiple, apply it, and then they'll come out with a valuation of $600,000. So the point here is that, typically that the accrual format should be based on every month going back over the trailing 12 months at a minimum for the buyer to come in and actually assess the overall health of your business. So they will look at not only your annualized figures, your trailing 12 months, but they want to make sure that all of those months in between are also in accrual format, because that'll give them a good view of how you operate your business and obviously the overall health of your business. So if your books are not in that accrual format, buyers will typically request that it is done such. So it's important to get that done as soon as possible. Now let's discuss how to actually implement proper accrual accounting, because it's one thing to say it and another thing to actually get it done. So here's some steps to guide us. Step 1, set up your team and your technology. Step 2, initial account review. Step 3, implement the procedures. And step 4, manage and review monthly going forward. So step 1, set up your team and technology. This is where, it's really important that you actually have a bookkeeper or an accountant who is well-versed in the e-commerce space. It makes it a lot easier because they'll actually know what the buyer is looking for, so they can properly set up your chart of accounts. They know to put things into accrual. So it's much easier when you're working with somebody who is, familiar with e-commerce and understands it. And it's okay to have a separate CPA for your year-end taxes. We see that all the time. Not an issue there. And also, you should have some type of internal champion, some type of employee, somebody internal who's dedicated to review those financials. They don't necessarily have to be a CFO, but they should ideally have some type of accrual accounting experiences and be completely dedicated to that task of handling the financials month after month. It could be yourself as well, but we find that a lot of business owners, get distracted by running the business and the financials fall behind. So that's something you don't want to happen. So keeping up on the financials will definitely help you in the long run. So get someone dedicated to do that. Next is the technology. We often see a lot of financials in Excel. You'll find that that's a big no-no. Buyers will actually want something in the QuickBooks or Xero format. So definitely get on some type of accounting platform. The most ones we're familiar with is QuickBooks, Xero. There's also Sage, other things out there, but have some type of standard platform that the buyers can then log into to review your transactions. And along with that, make sure your Amazon data is linked up to your software, QuickBooks or your Xero, whether you use A2X or ConnectBooks, because this minimizes any errors with manual entries being punched in by your accountant or bookkeeper. It's a direct flow of all your Amazon-based transactions right into your QuickBooks or Xero. And also your product cost schedule. Here's where it's okay to keep an Excel file. You should obviously every month or whenever they change, keep a log of your product costs by SKU. Not only will your accountant probably need this to book your product costs, but also more importantly, when you go into due diligence with a buyer, they will ask for your past product costs as well as your current. So it's a good idea to be in tune and up to date with all of your product costs by SKU. So definitely keep those in Excel and update your bookkeeper and accountant monthly when they change, and also update your log. Now, here are some just action items for you to take note of. Action item 1, acquire and document your accounting team and technology. Hire a bookkeeper to implement monthly accrual accounting. And implement that software we talked about, the QuickBooks or the Xero, and make sure it's synced up with your Amazon data, that flow, the automatic flow of the A2X or the QuickBooks of those transactions from Amazon. Step 2, to confirm your financials are actually in accrual. So the easiest thing to do is to ask your bookkeeper or your accountant, hey, are my financials prepared in accrual format, or are they on a cash basis? So that's the quickest way to get the answer. But also the easiest test is to make sure that your COGS as a percentage of revenue is similar month after month. If you see in your QuickBooks or your Xero that one month your COGS is 50% of revenue, and then the next month it's 90% of revenue, and then the third month it's 30% of revenue, you know that it's probably not being booked in a accrual format, because when your COGS as a percentage of revenue is kind of all over the charts, there's no accrual format. So, the best indication of accrual format is when you look month after month and your COGS as a percentage of revenue is very close, maybe a couple percentage points here or there, but it should not drastically change month after month. Also, look at your year-end adjustment problems. A lot of times when we review financials, we'll see that there's a major inventory true-up in December. which your accountant or bookkeeper should actually go back and retroactively apply it to all the 12 months prior. There shouldn't be some big plug in December when you're doing your inventory true ups, because that obviously will make December's numbers, it will throw them off, but also it shouldn't just be applied to that 1 month. So a true e-commerce bookkeeper will know that those inventory true ups should be spread out over the past 12 months, not so it's just getting one big hit in December. And also, request subschedules. So your inventory levels and your COG schedules will help you show whether or not they're accrual. So it's important that, you keep these inventory levels and your COG subschedules with your bookkeeper month after month. And it's really important, to have that champion review your inventory levels and your COGS data with your accountant or bookkeeper to make sure that things are in check and things make sense month after month. Because at the end of the day, your bookkeeper or accountant is human, errors will be made. So hopefully if you have someone dedicated to those financials, they could pick up on those errors and understand. And also more importantly, when you do get into due diligence, you'll need to be able to speak to the buyer about your numbers. So the more well-versed you are in your financials, the better off you'll appear and your business will appear to the buyer. Here are some action items. Confirm if your financials are prepared on an accrual basis. Example, asking your bookkeeper, like I noted, analyzing your financials, looking at that COGS as a percent of revenue will be a dead giveaway. So these are some things that you could do to actually get ahead of it, make sure you're in accrual format, speak to your bookkeeper. If you're not, definitely begin that process, because it can be, it can take quite a bit of time to actually get from cash to accrual. We've seen it take anywhere from a month or two to get that done. So it's best to do that now rather than waiting to get into due diligence, have the buyer request you get into accrual format, and then kind of delay the transaction because you're getting your books into accrual format. So start now while you have the time to do so, and you'll be in the better position for it. So step 3 is about implementing the proper procedures. First off, having the correct chart of accounts is really important. And here's where having a e-commerce savvy bookkeeper is really helpful. They'll show you the proper classification of where your revenue items and your expense items should be categorized, because quite often we'll see some books come over to us and we'll see an expense item being in the overhead, the G&A items, where it should be in the COGS or vice versa. Also, we'll see, contra revenue accounts be booked into COGS when it should be a revenue item. So it's definitely ideal for, this setup to be accurate, because it gives you an idea of your monthly performance. And that's good for yourself running the business. But obviously, again, the buyer will have, a better lens on, your business performance as well with this proper classification. And COGS accounting is 90% of the challenge. It's important that you implement some type of accurate, product cost system. So, as your product costs change, you want to make sure you have your own log, and also make sure that your bookkeeper or accountant is aware of it. So as product costs increase, be nice if they decrease, you want to make sure that you're actually reaching out to your bookkeeper and saying, hey, here's a list of my new products, my products cost by SKU. Here's the ones that's changed. Please make sure you implement it into the accounting system. Because quite often we've seen sometimes that a client isn't giving their bookkeeper the adjusted product cost. And then when they go into due diligence with the buyer is actually taking off from the POs all the accurate product costs. So when they recreate their P&L and their Q of E analysis, it'll be quite different from your QuickBooks or Xero. And the problem there is that you haven't been using your updated COGS all along with your bookkeeper. So very important that as your product cost changes, you alert your bookkeeper to adjust your QuickBooks or Xero. And they will use most frequently used is the FIFO method, the first in, first out, to calculate COGS. And then you want to reconcile your inventory periodically. We suggest quarterly, and you want to compare the net inventory value to your balance sheet to make sure they tie off, and your bookkeeper can help you do that. And when you're doing those inventory schedules, you want to make sure that you're looking at your inventory at all phases, in production, at sea, in a warehouse, in 3PL, at Amazon. So you want to make sure you capture all of your units and all of the value in some type of schedule, making sure that it reconciles to your balance sheet monthly. And again, your bookkeeper accountant can do this. And again, here's where it's important to have that, that accounting champion in your team to do these types of tasks with the bookkeeper. And then also setting up your G&A, your overhead expenses. It's a good idea from the get-go to create a separate line item within your QuickBooks or Xero and maybe label it non-business expenses. Now, here's where you'll go month after month and have your bookkeeper accountant actually post the transactions that would be considered add backs to this one line item, because it's quite cumbersome to go back in time as you're going to due diligence and pick out some of the expenses that are in the different charts of accounts and different line items and say this one's an add back, this one's an add back. So if you consolidate them into one line item along the way, and each month you put those non-business related items in there, it'll be much easier to track, none will get missed, and it's much easier to explain to the buyer during a due diligence period what each of those expenses relate to. So get it done now. If you don't have that set up within your chart of accounts with your bookkeeper, that is something quite easy for them to do. And you can probably go back over the last 12 months, 24 months and kind of pick out some items that would qualify for add backs and place those into that new non-business expense related item. Now, here's some action items for you. Work with your bookkeeper to set up an accurate chart of accounts for your business. And number 2, ensure you have the right procedures to accurately account for your COGS. The FIFO method, the quarterly inventory reconciliations, these are all important steps to take to make sure you're on the path to a proper accounting procedures. And finally, step 4, how to manage and review on an ongoing basis. So each time you place your product orders, it's really important to kind of, in one consolidated spot, track the actual details of the order. The name, the SKU, the quantity, the cost per unit, the dates. Make sure that's all in one spreadsheet or all in one tracking system that you're using. Then at the end of each month, you'll want to prepare for your bookkeeper all the information we discussed in step 2, as well as that list of all the COGS per unit for your products. And then step 3 would be, here's where that champion comes into play, having yourself or that champion come in and review the information for accuracy before you pass it off to your bookkeeper to incorporate into your financials. So, and then when your bookkeeper publishes your financials each month, you want to make sure that you look at your COGS as a percentage of revenue, because this will be the true test if you're in accrual format. So for example, I mentioned earlier that if you're looking at your historical COGS month over month, it's running at about 50-55%. All of a sudden, the new month comes in, you're looking at the financials and there's a jump to 70%, something drastic. You're going to want to look into that, to make sure there wasn't an error in the bookkeeping or there wasn't an error with, some product orders. So, this will be the dead giveaway that something is not an accrual, and it also, uncover lots of other issues. So make sure that month after month, you do look at the COGS as a percentage of revenue. Some action items, you want to implement an inventory tracking system where you log each order, like I said, the name, the quantity, the per unit total cost. And then each month provide your bookkeeper with accurate details that's been reviewed on your side of all the orders and the latest COGS. So let's talk about monthly financial statement process. So each month the statement should be finalized on the 15th of the month. So for example, if it's June and the month is closed out, June 30th, I'd say July 15th is when your bookkeeper accountant should have the numbers finalized in your inbox on your desk for your review. And it's a great way to hold them accountable. If you put something on your calendar on the 15th of every month, if you don't have these financials, definitely chase the bookkeeper and accountant. Then you want to spend at least an hour reviewing your financials. At first glance, it's going to seem foreign to you, but the more you interact with your accountant and bookkeeper and you have these discussions and they walk you through the P&L, the balance sheet, the cash flow, you'll get to understand them and get, a better grasp of what's going on and what to look for. So, and it also help you pick out, any issues. If you're monitoring your, for example, paid media as a percentage of revenue and you see it's decreasing or increasing, you can address issues like that. And also, performance, is it declining? Why is that the case? And if you're not on top of this monthly, there's no way for you to fix those problems quickly. If you don't look at your financials for 6 months and you go back in and you see you have some performance issues somewhere, it's already been 6 months past the time you could have went back and resolved it. So keeping an eye on the monthly financials will help you get a better grasp of your business and help you identify any problems that need to be solved and addressed immediately. And then you want to look at all 3 statements. As I mentioned, the bookkeeper, is really in tune with the balance sheet, the income statement, the cash flow, and how they're all tied and integrated together. So they're your best resource to help you walk you through those statements and get you, versed into being able to speak to them and review them. But again, it will take some time, but definitely get the ball rolling on that with your bookkeeper sooner than later. And again, this is where you'll address some of the problems your business is having, because the numbers don't lie. When you dig into the numbers, you will find any issues that you are experiencing. Some action items, again, implement a monthly review of the three financial statements with your bookkeeper and accountant, and communicate to your team to have the financials finalized by the 15th of each month. Set that as a hard deadline so that you dedicate that day and that hour, when you get those financials, to do that deep dive review, because at the end of the day, you're going to need to be in tune with your financials and make sure that you're up to date month after month and be able to speak to any of those transactions that occurred. So, what are the three integrated financial statements? Let's take a quick look. So, first you have the income statement, your profit and loss. And that's just your revenue minus your expenses equals your net profit, your SDE, your earnings. And most sellers are well versed, more so in the income statement versus the other two, which we'll get to in a minute, because that's actually what valuation is calculated off of. So, naturally, most sellers will review that financial statement first. This is always over a period of time, whether it be the last 12 months, a calendar year, a quarter. So that's more of a set period. Next, you have the balance sheet, which is the assets minus the liabilities equals the equity. And this highlights the financial position of the business, your assets versus your liabilities. And it's not as important for valuation purposes, but definitely for net working capital purposes, which we'll get into in a minute. It's definitely crucial to kind of review that for net working capital reviews and analysis. And the balance sheet is done at a point of time, always at an end of a period. So if it's last month, last year, and it's pretty much a snapshot of your business, and it gives you a good idea of your business health. And then lastly, you have the cash flow statement, which is just that. It's the inflows and outflows of the cash, giving you a net cash position. So this is probably the least reviewed by sellers, but actually it's the most critical, because this will give you an idea of what your current cash flow is to run your business and to grow. So if you have, any cash flow problems, here is the place to look for those problems. So, anything that is stunting your growth, or, if you need infusions of cash, you can go to your cash flow analysis and determine these problems from the get-go. So make sure you review that as well, because it's equally important that you have sufficient cash flow to keep your business running and growing. And this is always over a period of time as well. So this will be, your last 3 months. You'll go back and look at your cash flow analysis. So let's talk about, how these actually are integrated. I won't jump into each of these line items, but what you'll see here is a typical income statement, a balance sheet, and a cash flow statement. And not to get into the nitty gritty, but this is just to illustrate how things are related between these three statements. So for example, if you just follow the line, you'll see that net income, also pops up on your balance sheet. It's tied to your cash flow. You'll see that the accounts receivable and payable are on your balance sheet, also are tied to your cash flow. So, your business story is kind of defined by all three of these financial statements being integrated. So when you're doing that monthly review, I know it's natural to go look at your profit and loss, and kind of tie up on those figures, but also make your accountant and bookkeeper walk you through the other two as well, because again, they're going to be equally important. And, when you do decide to go to market, the buyer will also scrutinize all three statements and will probably give you a lot of questions regarding these. So again, good to know high level what these three financial statements do and how they talk to each other. And again, it's good to have your bookkeeper accountant explain this to you month after month. It will take some time to grasp, but eventually, the more you immerse yourself with it, the better you'll feel. Here's a northbound exit principle I'd like to share with you. To summarize, we find that a lot of sellers take more of a hands-off approach when it comes to financials, as it's more of a procedural item with them and they don't want to be bothered, but hoping that just from watching this video, you realize that it's quite the opposite of what they should actually be doing. And it's really important to get a grasp of your financials and review them monthly, as it gives you critical insight into your business, the growth, the performance, any trends. And more importantly, you should have a team to support you, a good accountant, somebody in your team to review the financials as well, as all these factors are going to make it easier for you to improve your decision making and your strategy. So I just wanted to leave you with that thought. To recap accrual accounting, I just wanted to reiterate the importance of getting your books in that accrual accounting format, because it's the only way to truly understand and analyze the profitability of your company as well as the overall health. It's like a real-time snapshot of your finances, which is really important. And also, your buyer will look at these financial statements and they'll value your business on it. So you want to make sure that you get that premium valuation that leads to a successful exit. So without having accrual accounting in place, you won't achieve these goals. I hope you enjoyed accrual accounting. Thank you.